Hey there. So you want to start saving for your retirement, but you don't have access to a retirement account. Well, I'm here to tell you, do not allow that to stop you from achieving your financial goals. Don't allow that to stop you from achieving your retirement dreams. In this video, I am going to share with you 4 ways for you to save for retirement without a 401k. If this is your first time at this channel, please hit the subscribe button below. Hey there, I'm Renee Collins. I am a CPA financial planner, and I'm also the founder of Retire Ready. Retire Ready is a firm that is dedicated to helping first generational wealth builders as well as entrepreneurs to develop a healthy relationship with their money so that they can save more, invest smart, and build wealth. At the end of the day, we all want the same thing. We want to make sure that our money is working just as hard for us as we are working to earn it. And today, what I'm going to be talking to you about is what are 4 ways that you can save for retirement without a 401k. Let's get started with the IRA, Individual Retirement Account. You basically have 2 options. Now, you can take the traditional route, the traditional IRA route, or you could take the Roth IRA route. Or you may even be able to do both depending on your financial situation. Well, let's go ahead and get started with the traditional IRA. The traditional IRA is a tax advantage savings account that will allow you to make a contribution up to $6,500 for 2023. If you're over the age of 50, you can add in another $1,000. Now, it's important to note that these amounts can change each year. Be sure to check the IRS's website to see if the contribution limits have changed. And I did put a link in the description below. Any contribution that you make into a traditional IRA is going to grow tax deferred. And what that means is that when you withdraw the money in retirement, you're going to have to pay taxes on it at that point in time. If you take the money out of the account before you turn 59 and a half, you will be required to pay taxes on the money as well as a 10% penalty. So we want to make sure that any monies that you're putting into the traditional IRA are going to be used for your retirement account. So what are the requirements? Now, the requirements for a traditional IRA as well as a Roth IRA is that you have earned income. You have to have income, whether it's from a salary or wages or tips or even self-employment income. You have to have earned income in order to be able to make a contribution into a IRA account. Now, you may qualify for a tax deduction for the traditional IRA. If you do not have access to an employer-sponsored plan during the entire year, you may be entitled to a full deduction of your contributions. And this is even true if you're married, as long as you file a joint tax return. So that could be a tax deduction of $13,000 for the year. Now, what happens if you're married and your spouse has a retirement plan at their job, but you do not? Well, you can still make a contribution to a spousal IRA. Whether or not you get the deduction, though, is going to be dependent upon your income. So if your income, your jointly filed income, is under $218,000 for the year, you're going to get a full deduction for whatever your contribution is. Now, if your income is between $218,000 and $228,000, then you're going to have a phase out of that contribution. And then once your income is over $228,000, then you no longer receive a tax deduction for your IRA contribution. Now, I want to make sure that I note here that you can still make a contribution to the IRA, but you cannot take a deduction for it once your income is over $228,000 when you're married and filing jointly. Now, one of the great things about a traditional IRA is that you have access to a wide variety of investment options. You can put stocks and bonds and mutual funds, real estate, and even ETFs into a traditional IRA. This is not the case with people who have access to 401ks. 401k plans are typically limited in the investment options that they provide to employees. So this is actually a benefit to you. So traditional IRAs can be a good tool for saving for your retirement. But I'm going to be honest, it's not my favorite tool. My favorite tool for saving for retirement is the Roth IRA. I absolutely love, 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 love the Roth IRA. It's similar to the traditional IRA in a lot of ways, but can you say tax free? The Roth IRA is a tax advantage retirement savings account similar to the traditional IRA. So you can contribute up to $6,500 for the year, and you will have access to a wide variety of investment options just like the traditional IRA. But there are some key differences. With the Roth, you do not receive a tax deduction for your contributions. Your contributions are going to be made with post-tax dollars, and your earnings are going to grow tax-free, not tax deferred. So when you take distributions from your Roth IRA after 59 and a half, your distributions are going to be tax-free. Can you say that? Tax-free. I love, 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 love tax-free. If you're like me and you believe that tax rates are going to increase in the future, then tax-free is where you want to be. Tax-free income in retirement means that you get to keep more of your income at a time when you need it most, at a time when you will not have a salary. So the more income that you can keep in your pocket and not in the IRS's is going to be a great deal for you. It's going to mean a lot to you in retirement. So if you're able to make a contribution into a Roth IRA, I strongly, strongly recommend it. So how do you determine whether or not you're able to make a contribution? Well, it's going to be dependent upon your income. If you're single and your income is under $138,000, then you can make a contribution into a Roth IRA. And if you're married, your income has to be under $218,000 in order for you to make a full contribution to the Roth IRA. And like I said, if you're able to make a contribution into the Roth IRA account, then I strongly encourage you to do so. Now, if your income is over these limits, there are other options available to you as well. And that is called doing a backdoor Roth. But that is a video for another day. With both the traditional IRA as well as the Roth IRA, you get to maintain control over your investments. And that can be a big benefit, especially if you should need those resources at some point in time in the future. Although, like I said before, I strongly discourage you from taking any money from your retirement accounts until retirement. But I understand life happens, and sometimes you have to do what you have to do in order to get by. Now, here is another option for saving for your retirement, and that is a taxable brokerage account. Now, this is a type of investment account that will allow you to buy, sell, and hold a wide variety of investments: stocks, bonds, mutual funds, exchange traded funds, very much like the traditional and the Roth IRA. But what's nice is that you can invest as much money as you want, and it doesn't matter whether you have income or not. There are no income limits to worry about, no contribution limits to worry about. You can contribute into your taxable brokerage account with after-tax dollars. So if you receive an inheritance from your grandparents, or you are a poor college student and you want to get started with your investment savings for the future, you can use a taxable brokerage account. Now, unlike retirement accounts, which offer great tax advantages, you get tax deductions, tax deferred growth, tax-free growth. Taxable brokerage accounts do not provide you with any type of specific tax benefits. Now, this means that any income that is generated on this account each year, whether it's interest or dividends or capital gains, it's going to be subjected to taxation in the year that it is earned. But the great thing about a taxable brokerage account is that you can withdraw your money anytime without worrying about any penalties or age restrictions. Now, another account that is oftentimes not really thought about as a retirement account is a health savings account. A health savings account is like a triple threat tax advantage account. It is tax deductible, the earnings grow tax free, and withdrawals, as long as they're used for qualified medical expenses, are also tax free. And you know me, you can't beat tax free. Now, what is a health savings account? A health savings account, I think the best way to think about this is a tax savings account for medical expenses. You can take a tax deduction if you make a contribution to the plan, and if your employer makes a contribution on your behalf, then you do not have to include that contribution in your earned income. Withdrawals from the HSA are also going to be tax-free as long as you use them for qualified medical expenses. And qualified medical expenses could be premiums, co-pays, deductibles, and any other medical expenses that would typically be allowed as a deduction on your tax return. And then once you turn 65, you can take non-medical withdrawals from the HSA account without incurring a 20% tax penalty. But you will pay income taxes, regular income taxes, on any distributions that you take out of that HSA account that are non-medical expenses. That's important to note. Now, a HSA account, it operates parallel to a high deductible plan. You must have a high deductible health plan in order to have an HSA account. So you can have this either with your employer or you can have a plan outside of your employer. Just be sure to ask the health insurance company that you're purchasing your plan from, what type of plan is it if you want to have a high deductible health plan with an HSA account. And then here's a planning tip. So you can have an HSA account and you do not necessarily have to have your medical expenses reimbursed in the same year that you incur them. You can keep your receipts, continue to contribute to your HSA account, allow that account to grow tax-free, and then you can submit reimbursement at some point in time in the future while your account continues to grow. So there you have it, 4 ways that you can save for your retirement. If you have any questions, feel free to reach out to me. I do provide a 30-minute complimentary consultation for those who are interested. Again, Renee Collins, CPA, financial planner, and the founder of Retire Ready. You guys take care and go be great today.